In the spring of 1720, the smartest man in England did something that should have been impossible. Isaac Newton, the mind that had mapped gravity and the motion of the planets, looked at the soaring shares of the South Sea Company, sold his stake, and walked away with a quiet fortune. Then he watched the price keep climbing without him. He could not stand it. He bought back in near the top, with almost everything he had. Months later, the bubble collapsed and Newton was ruined, losing what would be millions in today's money. He is said to have confessed that he could calculate the movements of the heavens, but not the madness of men. 3 centuries later, another man, arguably the greatest investor who has ever lived, has done the opposite. He has sold. He has moved to cash. And then, without a word of explanation, he has stepped away from the table entirely. He left no speech, no prediction, only an action. And if you know what that same action meant the last 2 times he made it, one question becomes very hard to ignore. What does Warren Buffett see that the rest of us, standing at record highs, refuse to look at? On December 31st, 2025, Warren Buffett did something he had not done in 60 years. He let go. After 6 decades running Berkshire Hathaway, turning a failing textile mill into a $1 trillion empire, he handed the title of chief executive to Greg Abel and stepped back. On January 1st, 2026, Abel took over. Buffett, at 95, kept the chairman's seat. But he made one thing unmistakably clear about what came next. He would, in his own words, be going quiet. Most of the headlines fixed on a single number. By the end of the first quarter of 2026, Berkshire was sitting on a record pile of cash and treasury bills worth roughly $397 billion. That is not a rounding error in a portfolio. That is close to 59% of everything the company could invest, more than half the war chest deliberately kept out of the market, parked in the safest instruments on earth. And here is where almost everyone reads the story wrong. They stare at the number. They ask how big the cash hoard is. But the number is not the signal. The number is the residue of a decision. The signal is the decision itself and the silence that followed it. Consider how strange that silence is. For 60 years, Buffett was the most quoted investor on the planet. He explained his thinking in folksy letters read by millions. He answered questions for hours at annual meetings that drew crowds of 40,000 people. Communication was part of who he was. And then, at the precise moment the market reached its most expensive levels in history, he chose to say almost nothing. A man who spent his entire life teaching the public how to think about money decided, at the very top, that the most important thing he could do was stop explaining and simply position. Think about how that cash was built. Berkshire did not stumble into it. Quarter after quarter, Buffett was a net seller of stocks. He cut his largest holding, Apple, a company he once called one of the best businesses in the world, by more than half. He sold down Bank of America, filing disclosure after disclosure as the position shrank. He bought almost nothing in its place. Year after year, the most patient buyer in financial history simply refused to buy. That is not caution. Caution is trimming a little. This was a 60-year-old reflex going dormant. The man whose entire identity was built on buying chose, at the top of the longest bull market in living memory, to stop. There is a pattern in history here, and it is not a market pattern. It is the pattern of empires. Britain did not announce the end of its dominance with a single dramatic gesture. It retreated quietly, market by market, colony by colony, long before anyone was willing to say the word decline out loud. The loud part comes at the very end. The quiet part, the positioning, the stepping back, the going still comes first, and it is almost always ignored, because it is boring and because admitting what it means is frightening. So ask yourself the harder question: why would a man who is 95 years old, who has nothing left to prove, who assembled the biggest war chest any company has ever held, why would he choose this exact moment to walk away from the decisions and go silent? Because here is what the headlines missed entirely. Buffett has done this before, not once, twice, and both times what followed was not a coincidence. To understand what his silence in 2026 might be telling us, we have to go back to the first time the greatest investor alive simply quit the game. The year was 1969. In May of 1969, Warren Buffett wrote to his investors and told them he was shutting it all down. He was 39 years old. He was not failing. He was, by any measure imaginable, at the absolute peak of his powers. The Buffett partnership had compounded at roughly 31% a year since 1957, turning $100,000 into more than $1.7 million, while the broader market crawled along at single digits. In 1968 alone, his best year ever, he had returned nearly 59% against less than 8% for the Dow. Investors were begging to give him money. He was turning them away, and he closed the doors anyway. The reason was disarmingly simple. He looked across hundreds of companies and could not find a single one worth owning at the price the market demanded. The bargains were gone. The era had a nickname, the go-go years, and the hot money was chasing glamour stocks at any valuation, certain the old rules no longer applied. Buffett did not argue with them. He just left. He told his partners they would do better in tax-free bonds than in stocks at those levels, handed back their capital and stepped out of the arena. People thought he had lost his nerve. The game had passed him by, they said. He was out of touch with the times. He admitted as much himself. He didn't understand the new market, so he wouldn't play it. Then the floor gave way. In 1973, the Dow fell more than 16%. In 1974, it fell another 27%. Peak to trough, the market lost close to half its value. The glamour stocks that had been priced for a perfect future were cut to pieces. Fortunes built on borrowed conviction simply evaporated. And what did Buffett do while everyone else was being carried out? He came back. With cash he had protected by leaving early, he moved in 1973, buying 8% of the Washington Post, while terrified sellers dumped it for a fraction of what the business was worth. He described that moment with a line that has echoed for 50 years. He felt, he said, like an oversexed man in a harem. The bargains were everywhere. He could buy anything he wanted. Look closely at the sequence because it is the entire thesis of this video. Buffett did not predict the decline. He never claimed to know the day or the hour. He simply observed that prices had detached from value, concluded the game was no longer worth playing, and went to cash and to the sidelines. The retreat was not an emotion. It was a price statement. When a disciplined buyer stops buying, he is telling you something specific. There is nothing here worth the asking price. That is exactly what he did in 1969, and it is what he has done, in slow motion, between 2022 and 2025, selling, refusing to buy, building the fortress, and finally going quiet. 2 retreats, 2 warnings sent in the only language Buffett truly trusts, not words, but action. The first was followed by the deepest market collapse in 40 years. But Buffett was not the first great investor to walk out of a room full of dancers. To see how old this pattern really is, and why it points straight at 1929, we have to go back further still, to a September afternoon when one man stood up and said the thing nobody wanted to hear. On September 5, 1929, a statistician named Roger Babson stood before a business conference and said 11 words that would make him the most hated man on Wall Street. Sooner or later, a crash is coming, and it may be terrific. He did not stop there. Factories would shut, he warned. Men would be thrown out of work. The decline would feed on itself until it became a full depression. That same afternoon, the market shuddered and dropped nearly 3%. They named it the Babson Break, the first tremor before the earthquake. And how did the establishment respond? It mocked him. Babson was accused of a lack of patriotism, of selling his own country short. The most respected economist in America, Irving Fisher, rose to dismiss him, insisting there might be a dip in prices, but nothing remotely like a collapse. Stocks, Fisher famously believed, had reached a permanently high plateau. The public chose to believe the optimist. Within 2 months, the market began the descent that would erase nearly 90% of its value and drag the world into the Great Depression. But here is the part that matters for our story. While the crowd laughed at the warning, a small number of people were quietly doing exactly what Buffett would do 4 decades later. They were leaving. Bernard Baruch, one of the most successful speculators of the age, had already pulled much of his money out of the market and into safer ground. He understood that the time to sell is when everyone is certain it can only go up. Joseph P. Kennedy, patriarch of the family that would one day reach the White House, is said to have gotten out near the top, telling the story that when a shoeshine boy started giving him stock tips, he knew the end was near. Whether the legend is exactly true or not, the fact is not in dispute. Kennedy exited and kept his fortune intact while the nation's savings vanished. And then there was Jesse Livermore, the most aggressive trader of his generation. He did not merely step aside. He bet against the entire market. When the dust settled and millions had lost everything, Livermore was reportedly worth $100 million, a staggering sum in 1929. He had read the same signals everyone else could see and chose to act on them while the band was still playing. Do you see the shape of it now? At every great peak, the room divides into 2 kinds of people. There are the loud ones, the optimists, the believers, the ones explaining why the rules have changed and the good times will last forever. And there are the quiet ones, the handful who sell, who raise cash, who walk toward the exits while the music is at its loudest, and who are ridiculed as fools or cowards right up until the moment they are proven right. Babson was the man brave enough to say it out loud, and he paid for it with his reputation. Baruch, Kennedy, and Livermore were the men smart enough to act on it without a speech. 40 years later, Buffett would become the purest version of that second type. The man who says nothing and simply moves his money. The names change across the centuries. Newton in 1720, Babson and Baruch in 1929, Buffett in 1969. The faces are different. The instinct is identical. Get quiet, get liquid, get out of the way. So if this keeps happening across 300 years, across different countries and different technologies, then it is not luck and it is not coincidence. It is a structure. There is a recognizable sequence by which every great top forms and breaks. And once you can see the 7 stages of that sequence, you cannot unsee them. Markets do not collapse out of a clear sky. They distribute slowly, mechanically, handing shares from the people who understand value to the people who only understand price. On Wall Street, they call this distribution, and it unfolds in roughly 7 stages. Learn them, and you will recognize exactly where we stand today. Stage 1, the new paradigm. A story takes hold that the old rules of value no longer apply. In 1929, it was electricity, radio, and the automobile. At the end of the 1990s, it was the internet. Today, it is artificial intelligence. The details differ. The sentence is always the same. This time is different. Stage 2, broadening participation. The public arrives. Ordinary people who never owned stocks start buying, certain that staying out is the only real risk. The last buyers enter precisely when there is no one left behind them to buy. Stage 3, narrowing leadership. Beneath the surface, the rally gets thinner. Fewer and fewer companies do the heavy lifting while the average stock quietly weakens. The index looks healthy because a handful of giants mask the rot underneath. Stage 4, quiet distribution. The smart money sells into strength, unloading shares gradually on the way up, so the selling never spooks the crowd. This is the stage Buffett spent 3 years executing in plain sight, and almost no one wanted to notice. Stage 5, the insiders cash out. The people who run the companies, who see the real numbers before anyone else, begin selling their own shares, even as they tell the public to hold on. Watch what they do, not what they say. Stage 6, the silence. The loudest bulls go quiet. The promoters stop promoting. The greatest allocator of capital alive hands over the keys and stops speaking. Confidence does not vanish with a bang. It simply stops being voiced. Stage 7, the trapdoor. Liquidity disappears first, then price. Everyone reaches for the exit at the same instant and discovers it is the width of a single door. What took years to build unravels in weeks. Now, the most useful proof that these stages are real is not 1929. It is the dot-com bubble of 2000, recent enough that many of you lived through it. In 1999, Warren Buffett was a laughingstock. Berkshire Hathaway badly trailed the soaring NASDAQ, and the verdict on Wall Street was brutal. The oracle was finished. He didn't understand technology. He didn't get the new economy. A famous magazine cover practically wrote his obituary, and Buffett's response was to do nothing, to refuse flatly, to buy companies with no earnings at prices that defied arithmetic. He sat in his unfashionable stocks and his cash and absorbed the mockery. We were living through stages 1 through 5 and calling it genius. The new paradigm was real. The public had flooded in. Leadership had narrowed to a cluster of tech names. The insiders were selling, and the one man with the discipline to stand aside was being mocked for missing the party. Then came stage 7. Between 2000 and 2002, The Nasdaq lost nearly 80% of its value. Companies that had been worth billions went to zero. And Buffett, who had looked like a fossil at the peak, looked like a prophet at the bottom, sitting on cash, ready to buy the wreckage. That is the pattern, start to finish. The reframing of value, the crowd, the narrowing, the quiet selling, the insider exits, the silence, and the trapdoor. We have watched it run at least twice in living memory. The uncomfortable part is how many of these 7 boxes are already checked in 2026. But stages tell you how a top forms. They do not tell you what pulls the trigger. For that, we need to look at the 5 specific conditions that, again and again, push the smart money toward the door. If the 7 stages are the anatomy of a top, the 5 triggers are the pulse. These are the conditions that, throughout history, have preceded the moment the smartest money turns and walks. When they appear together, the great investors stop talking and start selling. Trigger 1. Valuation reaches an extreme. Price detaches from anything the asset can realistically earn. Buffett himself once warned that when total market value races far beyond what the economy actually produces, investors are, in his phrase, playing with fire. It is the oldest signal there is and the easiest to rationalize away. Trigger 2. The bargains vanish. This is the one that drove Buffett out in 1969. Not fear, not a forecast, simply the inability to find a single thing worth buying. When a value investor cannot put money to work, the market is telling you its price. Trigger 3. Dangerous concentration. The entire market becomes a bet on a handful of names. And the cleanest illustration in modern history is not American, it is Japanese. By December 1989, the Japanese stock market had become the largest on earth, and the mania was total. The land under the Imperial Palace in Tokyo was said to be worth more than all the real estate in California. The Nikkei index touched almost 39,000. Investors believed Japan had discovered a permanent formula for prosperity. Then it broke. The Nikkei would spend more than 3 decades below that peak. An entire generation of investors who bought at the top and never, in their working lives, got back to even. Concentration and certainty are not strength. They are the precondition for catastrophe. What makes Japan so instructive is who got hurt. This was not a casino full of reckless gamblers. It was an entire society, pension funds, salarymen, ordinary families who had been told by every authority they trusted that their economy had cracked the code. The most respected voices were the most wrong, and the discipline required to step away from that euphoria, to sell when everyone you knew was buying, was almost superhuman. Almost no one managed it. That is the point. These triggers are easy to list and nearly impossible to act on, because acting on them means standing alone against everyone you respect. Trigger 4. Euphoric consensus. When every voice agrees that prices can only rise, there is no one left to do the buying that keeps prices rising. Consensus at a top is not wisdom, it is a countdown. The very unanimity that feels so reassuring is the mathematical proof that the fuel is almost gone. Trigger 5. The handoff. This is the subtlest and, right now, the most chilling. It is the moment the people who built the fortune begin handing it to someone else. The founder retires. The legend steps back. The capital is passed to a successor at the very moment the builder chooses to stop building. Hold those 5 against this exact moment. Valuations stretched to historic extremes. Bargains so scarce that the world's greatest buyer refused to buy. Concentration in a tiny cluster of companies carrying the entire market. A consensus so euphoric that caution sounds like heresy. And the handoff, Buffett passing a record fortress of cash to Greg Abel and going silent. 5 for 5. So if every trigger Buffett has ever responded to is flashing at once, the obvious question is what his chosen successor is actually doing with that fortress. Because in 2026, the story took a turn almost nobody expected. Here is where the simple version of this story falls apart, and where the honest version becomes far more interesting. If Buffett built the largest cash position in corporate history because he was bracing for disaster, you would expect his successor to sit on it, frozen, waiting for the storm. Greg Abel is doing the opposite. He is spending. In his first months as chief executive in 2026, Abel moved aggressively into one name above all others: Alphabet, the parent of Google. He more than quadrupled Berkshire's stake, buying roughly 65 million shares worth, in the neighborhood of $21 billion, pouring billions more into what has quickly become his single largest new bet. This is not a man hiding under the bed. This is a man making a decisive wager on the future of artificial intelligence. And yet, look at the other side of the ledger. In the very same stretch, Berkshire was cutting positions loose entirely, fully exiting Visa, MasterCard, United Health, Amazon, and a string of others, out of the payment networks, out of a major health insurer, out of one of the great technology platforms of the age. This is not retreat, and it is not panic buying. It is rotation, a wholesale reshaping of the portfolio, selling the crowded and the expensive, concentrating into a single conviction. So which is it? Is the fortress a shelter, or is it ammunition? This is the moment to be completely honest with you, because the truth matters more than the drama. Warren Buffett never stood up and predicted a repeat of 1929. He issued no warning anyone can quote. He named no date. He made no speech. Everything we have described, the silence, the cash, the handoff, is action, not prophecy. We are reading the behavior of the most disciplined investor alive and asking what it implies. That is interpretation. It is not a transcript. But interpretation is not nothing. Because a fortress of cash is only a warning if you understand what it was built for. You do not assemble $400 billion in dry powder to earn a modest yield on treasury bills. You assemble it for one reason above all, so that when prices finally break, you are the buyer with cash while everyone else is the seller without a choice. That is the entire Buffett playbook, run in 1973, run in 2009, and now loaded and handed to a successor. Seen that way, Abel's behavior is not a contradiction of the warning. It is the warning's logical next chapter. He is doing precisely what the playbook demands, trimming the overvalued and the crowded, holding the fortress mostly intact, and deploying selectively into the few things he believes can survive whatever comes. Notice what he sold: the payment networks and the insurer, and the platform stocks that the entire market had crowded into. And notice what he kept dry: hundreds of billions, untouched, waiting. The succession itself is the signal. You do not build a war chest like that at the top of a historic bull market and then hand it to your chosen heir, unless you expect there to be a war. Which brings us to the question that should keep every ordinary investor awake. Because whatever Buffett and Abel are positioned to do when the break comes, the rest of us are positioned to be something very different. We are positioned to be the people they buy from. Here is the cruelest truth about every great top in history. The people positioned to survive it are quiet, and the people about to be destroyed by it are loud. The survivors do not announce themselves. They do not write op-eds. They sell into strength, raise their cash, step back from the table and go silent. Newton cashing out before he lost his nerve. Baruch slipping out before 1929. Buffett folding his partnership in 1969 and going dormant in 2025. The victims, meanwhile, are everywhere and audible, confident, invested, certain that the people heading for the exits simply don't understand how much things have changed. And when the break finally comes, the survivors need someone to sell to them at the bottom. They need a counterparty. They need a crowd of frightened people dumping good assets at terrible prices. That crowd is not a villain in this story. That crowd is us. In the language of the market, ordinary savers become the exit liquidity, the supply of cheap shares that lets the patient and the prepared get rich. You do not have to imagine what that feels like. You watched it happen in 2008. The 2008 collapse was not at the street level, a story about subprime mortgages or credit default swaps. It was a story about ordinary people who had done everything they were told to do. They bought homes. They funded their retirement accounts. They trusted the consensus of their banks, their advisors, and their financial media, every authoritative voice assuring them that housing only went up and the system was sound. When Lehman Brothers failed in September of that year, a 150-year-old institution evaporated in a weekend, and the people who paid for it were not the architects of the disaster. They were the families who watched their 401ks lose half their value, who lost homes they had been encouraged to overpay for, who were forced to sell at the very bottom because they had no cash and no choice. Meanwhile, the prepared moved in. The investors who had stayed liquid and skeptical, the ones who had been mocked for sitting in cash while the boom raged, bought the wreckage at prices that would never come again. The asymmetry was total. One side became the cautionary tale. The other side bought the cautionary tale's house. And the gap between those two sides was never about intelligence. The families who lost everything in 2008 were not stupid. They were trusting. They did exactly what they were told by people who sounded credible and confident. That is what makes this pattern so merciless. It does not punish the foolish and reward the wise. It punishes the trusting and rewards the skeptical. And at the top, trust always outnumbers skepticism by 1,000 to 1. Now line up the moments. 1929, 1973, 2000, 2008. Different decades, different triggers, different technologies, but underneath, it is one story told over and over. A euphoric crowd, a handful of quiet skeptics moving to safety. A break that comes faster than anyone believed possible, and a transfer of wealth from the many who believed to the few who prepared. Spain drowned in the silver of the New World and went bankrupt anyway. Britain's empire dissolved while its public still assumed it was permanent. The Soviet Union looked eternal right up to the year it ceased to exist. Permanence is the great lie that every peak tells, and the people who believe it are always the ones left holding the assets when the music stops. So return finally to where we began, to the silence. In 2026, the single most successful allocator of capital in human history built the largest pile of cash any company has ever held, stepped away from the decisions, handed the fortress to his successor, and went quiet. He issued no warning. He named no date. He simply did, in slow and deliberate motion, the exact thing he has done only twice before in 60 years, and both times what followed punished everyone who ignored it. That is not proof that a reckoning is coming. Maybe this time really is different. Maybe artificial intelligence rewrites the rules of value the way the optimists promise. Maybe the fortress sits idle for a decade and the doubters look foolish. History does not deal in certainties, and anyone who tells you they know the day is lying. But history does deal in patterns, and the pattern here is not subtle. When the disciplined go quiet and go liquid at the top, it has never, across 3 centuries, been because they expected the good times to continue. Newton saw it and lost his nerve. Babson saw it and was called a traitor. Baruch and Kennedy and Livermore saw it and got out. Buffett saw it in 1969, sat out the worst bear market in a generation, and came back to buy the rubble. Now he has seen something again, and rather than tell you what it is, he has chosen, at 95, with nothing left to prove, to simply stop playing. So here is the question to sit with tonight. If the greatest investor who ever lived has quietly assembled $400 billion in cash, refused to buy at these prices, handed it all to his successor, and fallen silent at the exact moment the market is hitting all-time highs, what is it that he sees, standing where he stands, that the rest of us cannot bring ourselves to look at? The warning was never going to be spoken out loud. The loud part always comes last. By the time the danger is something everyone is willing to say, the people who needed to act already have. And you are no longer early. You are the exit. The dance is still going. The music is still loud. And the man who has watched this song end 3 times before has just very quietly left the floor. If this changed the way you see what's happening right now, subscribe, because when the pattern moves from these pages into the headlines, you are going to want to understand exactly what you're watching. The answers were never hidden in the future. They are written in the past. And I will keep showing you where to look.